Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 4:30 in New York. Equities have closed. We're looking at settlement of the Dow Jones Industrial Average, which has closed nominally higher, in essence unchanged to up a little bit. As you can see, current print is 17,229, putting it up about 16 points on the day. Very, very slight change. I would call that, in essence, unchanged. Of course, we've got the Fed meeting set for this week, and I think we have some reluctance for aggressive trading up until the point in which we see what the Fed has to say. Now, in terms of how that's affected our current trade, of course, we are long the Standard & Poor's 500 E-mini from about 1979. We've got that market trading off about a point and a quarter at 2009. As I said, we are in at 79, so we've got some pretty decent profits. We are going to look to trail that stop higher. So traders, when you look at a daily chart of the Standard & Poor's, and that's exactly what we're doing, there's a couple of things that absolutely jump out at me, and let's kind of go through them. Now, the first thing is that we've got a very, very quiet day with very, very little range when you consider the open, close, high, and low are all within this particular doji candle that you see here. And we're getting a doji obviously because the open and the close are almost identical, and that can absolutely indicate a pivot point in terms of a candlestick pattern if we take into account this large rise that we saw on Friday and this particular doji that we have here. It's simply called a harami cross. And a harami cross, of course, is because you don't have a bullish or bearish candle that's on the inside, an inside trading day of that. That's the first thing that we notice and can identify. The second thing that we can notice that to me is critically important is we at no point during the trading day really surged well above this long-standing 200-day moving average. And to me, that's what's absolutely critical, is that we have this market move and trade above that particular price point. Now, in terms of the bullish side of the fence, we can simply look at this as a rest area, a consolidation area before moving higher, but we really need to hold in terms of a support area long-term, roughly this 2000 price point on the Standard & Poor's 500. Now, it could easily dip within it. As you can see here, it came down to what, almost probably 82 or 83, and then moved back up before dipping back down with a higher low here. And so when I look at the potential of putting a stop just under 2000, my fear is that it really doesn't give us any kind of flexibility whatsoever. So I am going to make a recommendation, and the recommendation is to move your stops up, but you want to move your stops up below the low of this candle here, which is that large move. Now, in terms of where that comes in, let's go ahead and move our pointer. It comes in at around 1988. So my suggestion is to trail your stop from 65 to 88, 1988 on a protective stop. We'll have to see if that stop holds and the market moves higher. If it does come and hit us out at that point, at least it hits us out with about a 10% gain. But I feel as though because we didn't get real strong momentum or follow through today, that moving that stop up makes some sense. Whether or not it stops us out, my hope is that obviously it will not, and we will continue to see this market move higher. But the key to me right now is that we have to see effective closes above this 200-day moving average. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another Trending Markets. Bye-bye.